understand what is going to be the timeline for this 160 crore CapEx for, do we have anything concrete with the clients? Have you placed the orders? How is it going?
Okay, so thank you for the question. The timeline, as I said earlier, is to spread it across this financial year and the next one. For specific orders, we cannot give out details because those are business strategies. But yes, we do have certain orders lined up. Some of the capex will be done in the first half of this year itself, and that will become more clear once the details are out.
Okay. And what amount can we expect going forward as a depreciation cost, because it has come down significantly in the Q4?
I'm sorry, I didn't understand the question.
So in Q4, the depreciation amount has come down significantly if we compare it to previous quarters. So is it going to be the same, it has in Q4?
Yes. Yeah, it should remain similar to what you've seen in Q4, but with the addition of new equipment, that depreciation of the new equipment will definitely lead to certain change on that. But you can do your math accordingly, and it'll be difficult to give you a depreciation number as of now, but the Q4 numbers are indicative of what you would see going forward.
Completely understood. And we are doing something on EPC. Can you elaborate on that? Have we closed some deals, or how are we progressing on that?
So with regards to EPC, we have been working on some orders to get for the EPC segment, but we are very choosy and picky on that because we do not want to hamper any of our margins that are currently there. And the idea is to maintain sustained growth rather than going for large numbers for the sake of adding the top line. So we have not ventured into run-of-the-mill EPC contracts. These are specialized works that are required in the industries that we are working in currently, and the target is to get some good contracts in this financial year and get them up and running. So as of today, we do not have any contract, if that is what the question was. We do anticipate that we'll have something in this financial year itself.
Are we targeting any specific segment or any specific industry, or is it what do we have in mind when we are saying that specialized BPC work?
It will be too difficult. It will be too open for me to give out the business strategy as of now. We are targeting the sectors that we are operating in, primarily the ones that are part of our revenue mix. So that should give you an idea of where we stand, and what exactly in the contracts, that again will become clear once we are able to bag something and we'll declare it.
Okay. Thank you so much, and have a good luck.
Thank you.
Thank you. Next question is from the line of Jehan Bhada from Nirmal Bang. Please go ahead.
Yeah. Hi, Himanshu. Thanks for the opportunity. So, can we infer that ballpark capex per year, current year and next year, would be 80 crores each?
Thank you for the question, Mr. Jehan. Yes, that could be the ballpark where you could see about 80 odd crores this year and 80 next year.
Right. So regarding this year's 80 crores, by when can we see the deployment of the equipment at sites?
So given the cyclic nature of the industry, we do see that the deployment will happen Q2 onward.
Okay, got it. And last question on funding for this capex over 2 years. Will we need to raise any capital for this, equity capital?
We haven't yet taken a decision on any equity capital raising as such, but if anything does come up, that will be announced in due course of time. But as of now, it is targeted through internal accruals and debt funding.
Right. Okay. And one more question, Himanshu. If you can throw some light on the equipment renting industry, because primarily whatever listed companies are there, they are mainly into wind, a couple of them. So if you can share something about overall equipment renting industry where you particularly cater to.
Right. So
how many players, how many competitors, etc.
Okay. So, we are primarily, as you have seen, we are operating across sectors of infra, metals, cement, petrochemicals, and there are certain other sectors, smaller sectors. So the way it works is the equipment is rented out to our clients for their various projects as per their requirement, where they are executing, be it a capacity expansion project, where in a cement plant, let's say they are constructing a new plant altogether or expanding on a running cement plant. So various types of cranes, starting from the smallest, be it 15-ton pick and carry crane as manufactured by Action Construction or the like, up to larger cranes of about 1,000 tons capacity as well, which are brought in primarily from outside, are utilized by these clients for manufacturing their, constructing their manufacturing facilities. And there the competition as such would be that, apart from the organized players, which is one being Sangvi and the other being still unlisted companies, but they're still better off because of being in the industry for a long time. There's some competition from smaller players also at times, but as specific competition in the larger crane sector, that is very limited. So the visibility is more clear in that space.
Right. Okay. Thank you so much, Himanshu.
Thank you.
Thank you. Next question is from the line of Kaushal from Adinath Wealth. Please go ahead. Mr. Kaushal, you can go ahead with your question. Hello, Mr. Kaushal, you can go ahead with your question. As there is no response.
Hello?
Yes.
Yes, we can hear you, Mr. Kaushal. Yeah.
As there is no response, we'll move ahead to the next participant. Next question is from the line of Utkarsh Patel from Motilal Oswal. Please go ahead.
Yeah. Hi. Congratulations for a good set of numbers.
Thank you.
Yeah. I wanted to check on one piece, this depreciation piece, right? You said that you have a depreciation of 6 crore in the previous quarter, right? And for the full year, it is closer to 30 crore for Tara Chand as a company.
Right.
And if I see the average net block for the full year was closer to 260 to 70 crores, and the average net block is 160 crores for the full year, right? So the depreciation on the average number the percentage looks a bit high. And even if you compare with some of the peers that we have, right, this number is kind of towards of the peer set, right? So is it something that we have been doing? We have been depreciating it more consciously, and now we are kind of moving to a bit more realistic estimate in terms of depreciation, or what is the thought process behind this?
So the one change that I would say that has come about is over the last couple of years, the company has brought in larger machines which were not part of the fleet earlier, primarily. So a lot of the capex that has been done over the last 2 years or so has been into large cranes, primarily crawler cranes, which do tend to depreciate over a longer period of time. So that change has come into effect into the depreciation numbers, and certain correction, as I had answered an earlier question, has been done from Q4 of the last financial year, which the impact is visible in the numbers as well.
Okay. So the Q4 was not a balancing number as such, right? And it's more like 6 crore would be the run rate from Q1 onwards, excluding whatever new capex you'll do, right?
That's correct.
Okay. Understood. That's it from my side.
Thank you.
Thank you. Next question is from the line of Rishit Shah from Nuvama Wealth. Please go ahead.
Hi, sir. Good evening. Thanks for the opportunity, and congrats on a good set of numbers. So just one question, while all the other questions have been answered, just one question. So we highlighted in the opening remarks that the transportation segment has seen a 400 basis point decline in margins. Can you highlight the reason for this?
Yes. So thank you for the question. So the decline in margin in the transportation segment has been because of certain new contracts that came into being in the last financial year itself, and they have taken a little bit time to take off. So that has led to a stress on the margins. And we see, because of these contracts being long-term, like 4 to 5 years, so usually the stress in the first year or first 6 months or so of a starting contract does average out over the next balance period of the year. So whatever challenge we've had, we see that being made up in the coming years.
Okay. Got it. Thank you so much.
Thank you.
That's it.
Thank you. Next question is from the line of Sunil Jain from Nirmal Bang Security Private Limited. Please go ahead.
Thanks for taking my question. Sir, you said that the yield is 2.85%. So even if I take your gross block at 298 crores, which you had said at the year end, the revenue works out to 102 crore, but your revenue is 174 crore. So what is the difference?
Sir, to answer that, we are into 3 different segments, and our gross block of 298 includes all our machinery, plant, and even any land or other aspects of the entire fixed asset book, right? So the revenue mix that we get for our equipment, hiring in projects, that is where we are talking about the average yield. Whereas in our warehousing and transportation, the deployment of equipment or assets is much smaller compared to the equipment rental business. So if you do a revenue mix comparison, there you'll be able to get a better understanding of this number that you're looking at.
So, but in warehousing also there is a deployment of equipments and all.
Right, but that is done. No? It is not on hiring. So in the warehousing segment, it is on the tonnage of steel handled. So the economics work on the tonnage of steel handled, where equipment is a component of the overall picture. And that is why we do not work on a yield on a per month basis, because it is not a rental model there.
So the second segment where you get an yield, and for that, how much is gross block? Can you disclose that or no?
I don't think we have the gross block numbers on that, or those are disclosed. I'll have to get back to you on that, sir.
Okay. Yeah, fine. Thank you.
Thank you.
Thank you. Next question is from the line of Sunil Shah from SRE PMS. Please go ahead.
Yeah, so thanks for the opportunity. First question is, we have about 300 equipments which we are giving it on rent. Sir, what would be the replacement cost of those machines today? I think our net block is at about 260-70 crores. But what is the replacement cost of this machine, if you can know that?
Okay, so thank you for the question, sir. So our gross block as of date is about 298 as of 31st March 24, and our net block is 180 odd crores. So if we are looking at a replacement, usually it is again a tricky question, because it is all dependent on the demand. The equipment is able to sell out at about 60% of its original value, even after about, say, 8 to 9 years or 10 years of usage. But if the market is very good, the number can be much higher. So what you see as a net block as of now, the best case scenario, I would say, can even be about 220 odd crores, and the worst case scenario on a replacement basis would be about 150 odd crores.
So safe assumption would be assets as of today more closer to the net block, like 180 odd crores would be a safe assumption. So the numbers match according to the annual report. So my second question, as you explained very nicely on your equipment leasing model, how does this warehousing and logistics business work? For me to understand, like steel companies, they make the steel and we procure from them, put it in our warehouse, and then wherever they want across the country, we distribute it to their distributors. How does that work? If you could explain to me in very simple, logical terms.
Sure. Thank you. So in our steel warehousing and logistics, basically we're working with the manufacturers of steel, wherein there are branch warehouses of those manufacturers, so owned by them, or there are branches where the warehouses are owned by us. But they are under contract with the primary customer, which is RINL or SAIL. The products that are manufactured at their plants are shipped by them through rail or by road. If it is by road, there are certain contracts where we have the road transportation under us. Otherwise, there are other parties also in the market who are doing the road transportation, and then there is rail transport, which happens through various contracts that the clients have with the Indian Railways. So the material is received in the warehouses, where our then contractual obligation is to unload the material, stack it in the stockyard as per the guideline of the client, then load it onto the trailers for dispatch to their end user client. So that is the composite services that we have to provide to our customer, to our client, and in that there are inbuilt transportation contracts where the end user requires material is being transported by SAIL itself to its doorstep. So there we get involved in part of the transportation as well to the end user's doorstep.
Right. So this are like, if I'm understanding it, it's a very, very long-term contract of, as you said, 5-6 years or so.
Right.
There would be various price escalation risks which would be involved over this long period of time. How do we, or is there any back-end tie-up with those companies? How do we mitigate that?
Okay.
Because
so on the
fuel prices, etc. Sorry, please.
Sure. No, sorry to cut you off. Yeah. So, on the escalation front, the contracts have inbuilt escalation for the fuel and manpower cost, which are two main components. And those formula are in play, and on a yearly or half-yearly basis, as per the contractual terms, the escalation is claimed from the client.
Okay. Fine, sir. So I just wanted to get some understanding on the USP or, the stickiness of those customers to remain with us over the duration of time. So just want to get that understanding, if you could make me understand that. Why would a SAIL be with me for like 6 years? What is it that I bring on the table for him?
Right. So see, we've been into steel warehousing and logistics for 4 decades now, and by the virtue of the contract, this being a government tender and the contractual terms saying that it has to be there for 6 years, so that one is a statutory requirement that the contract has to be there for 6 years. 2, because of the virtue of our being in this segment and being an expert player in this area now over these years, that stickiness is there. And 3, we have brought in innovative techniques for handling of steel. We are the only private company in the country to own 10 rubber tire gantry cranes, which are used for efficient handling of steel. Apart from us, the only companies that have their own rubber tire gantry cranes are Steel Authority of India Limited themselves, RINL or Tata. And I think JSW is also bringing it now. So we have brought in innovative techniques of handling steel, which has added to the stickiness of our customers.
Okay. So if I can ask one more question, on the equipment, we mentioned that we are having a yield of 2.85% on a monthly basis. If we can get a percentage on our warehousing basis as well, because for me to understand, this yield works out great on an annual basis of 2.85%. But what about on the warehousing? Because on my capital employed, what is it at end of the day I am able to earn from both of business verticals?
Okay.
So,
to answer that, sir, I think I was trying to answer in the earlier question as well. Because this is a composite service and the equipment is not specifically given out on a rental basis, so the yield is not calculated by us on a monthly yield basis. Here, the target more so is to work towards ensuring that we handle the highest possible tonnage of steel as per the contractual terms, so that the income and the revenue and the profitability can be worked out on that. So it will be difficult for me to give you a yield number for that segment.
Fair enough. Just one last bit. Is our rentals on the warehousing connected anyways to the steel prices?
To the
steel prices, the volatility of steel prices. Is it
Nothing at all. Our prices are fixed for the contract plus the escalation clause that is there. And the only change with steel prices is basically the demand and supply in the market, which leads to the change in probably at times the volumes of steel handled by us. But because production is happening round the year and round the clock, so steel has to come out and we have to keep handling it. And so there is no major challenge or change with regards to steel pricing there.
Right, sir. Thank you so much, and connect with Stellar and book your time for another call. Thanks so much for that.
Thank you. Thank you, sir.
Thank you. Next question is from the line of Anand Sarda from CIL. Please go ahead.
Hi, Himanshu. Thank you so much for the opportunity, and congratulations on a good set of numbers. So, do we envisage to also participate in more tenders for warehousing, like new long-term tenders for segment B?
Yes. So, to answer that, thank you, Mr. Sarda, for the question and the congratulations. So, we are always looking for new tenders whenever they do come up. And I was just answering an earlier question where a new contract we had won recently just started execution in May 24 itself. Similarly, there will be other contracts that do keep coming up, and we do our due diligence with regards to the visibility on the possible margins and the pricing that we can get for those contracts, and that is when we take a call on participation.
So this 160 crore of capex that is to be executed in 2 years does not include any capex for the warehousing segment, sir. Does it include?
No. Nothing that at least the 160 crores that has been proposed with Zoomland, that is not considering the warehousing segment. But therein, I would like to add the capex for any new contract is very limited because they are much smaller machines which are used for the warehousing and transportation works, and the kind of fleet we have for our trailers and the associated network, which has close to about 500 trailers as part of our committed partnered trailers. So we do not require much greater need for adding more and more capex in this segment, even with new contracts.
Okay. And what is the strategy when you decide how much of capex that you want to spend on cranes? I mean, 2 years, 160 crores, you're doubling your net block. You already have some orders in hand. That's why you are buying these cranes, or like, how do you foresee that much?
Right. So with the network of our clients, yes, there are certain orders in hand which enable us to take a decision. Plus, with the kind of network and rapport that we have with our clients due to our existence in this sector for 20 odd years now, we have a visibility on what the possibility of which equipment is going to be there, and which will give us a long-term visibility vis-a-vis the margins as well. So that has helped us to chalk out the equipment that we wish to buy, and we have gone for a bulk proposed purchase plan with the supplier to ensure that we have the availability of that machine once the orders are in place, so that we've done an initial booking per se to just kind of give an idea. So that we have given a target on when the equipment would be required based on the discussions and, in principle, understandings with our clients. So that has been the basis for that purchase plan.
Okay. And the last question, going forward, what do you think, because there's a certain expansion that will happen in your company, what do you think will be the average monthly yield, which you can tell me after, after you buy the 160 crore of capex? And what is the net yield right now? And, what was the net yield last year, like in FY23?
Yeah. So to answer that, the yield for the new equipment that we are bringing in, we will the idea is to maintain the yield levels that we are at right now, because they are at a pretty healthy level. And those are the yield figures that we would anticipate, and we understand with the kind of orders that are being discussed that we should be able to maintain those yield levels. With regards to net yield, the net yield roughly comes to about, for the current net yield, the gross yield that we have given is 2.85%. Against that, we can consider a net yield of about 1.95%. And similarly, for the year prior to that, our net yield would have been around, I do not have the figures in front of me right now, but from what I recall, they were about 1.7% the year before that.
Thank you so much, Himanshu ji, and congratulations once again.
Thank you. Thanks a lot.
Thank you. Next question is from the line of Bhavani from Krijuna Research. Please go ahead.
So thank you, sir, and thank you for the opportunity, and congratulations on good set of numbers. So I just wanted to know that also some of my question has been answered, but I wanted to understand that you said your monthly yield is 2.85% with regards to equipment rental yield. So I just wanted to know, how do you arrive at this number? How do you calculate this?
So the yield is calculated, sir, thank you first for the question and the congratulations. And the yield is calculated basis the revenue that we earn from the equipment, from the rental revenue that we earn vis-a-vis the cost of equipment that we are deploying for that specific revenue. So for example, if we are deploying a 10 crore crane and we are earning 25 lakhs out of it, that will lead to be 2.5% is the yield for that. Just to give you an idea.
So that will mean that since your rental is 2.85%, so if I can say a payback period of 3 years for any new crane which you purchase right now?
Ideally, yes, that would be the scenario if this is sustained over the 3-year period. But because of the industry being cyclical, it is hard to give you a clear-cut yes on the 3-year figure, 3-year number that you said. But yes, at 2.85%, it easily calculates to 3 odd years as the result.
And sir, one last, do we expect this rental yield to go up in the further years, financial years?
As I was just answering the earlier question, sir, we are already at healthy numbers. We are targeting, obviously, the target would always be to improve on those yields, but we do see that it will be good to sustain these numbers, and we'll have a better visibility on any increase in the yield probably by Q3.
Okay, thank you, sir.
Thank you.
Thank you. Next question is from the line of Dolly Chaudhary from Niveshaay. Please go ahead.
Thank you for the follow-up, sir. I wanted to know on steel logistics side, like, are we planning to enter into private segment also, or how competitive this industry is?
I could not hear you correctly, clearly, Ms. Dolly. Could you please repeat?
Yeah, I wanted to know on steel logistics segment that how competitive this industry is, and are we planning to enter into private sector as well? Because just, as of now we are doing PSUs only. So are we planning to expand our segment?
Yes. So we are already working somewhat with our private clients as well, be it Tata, Jindal, AM/NS. And but because of them not being large volumes right now, so we haven't had them become major clients in that segment. But we do have the opportunities to work with them in the warehousing and logistics sector as well, whereas we are already working with them in the equipment rental segment. With regards to competitiveness, it is for any industry, the competitiveness is already there. There are people who want to do the job and everybody wants to get it. So, but with regards to how competitive, these are all specialized natures of job, and they require certain understanding of how steel industry works. So only people who are attuned to understanding of the nature of the industry are able to compete in these contracts. So that makes it a little niche. But within that, it is competitive. We do get the advantage of having better equipment and better expertise with our knowledge and experience of 40 odd years, which helps us to be more competitive on that.
Okay, and just on our guidance that we have guided to grow at a 30% year-on-year basis. So if you can please throw some light on the segment size, how are we planning to go for equipment? Because we are doing capex and equipment rental, so I guess we are planning to grow more than 30% in that segment is what I'm getting.
Yes. So it will be a through and through growth with probably equally distributed across both sectors, because as I was answering the earlier question, the asset addition in the warehousing and logistics is not very high, even if we get new contracts. So the target is to maintain the growth across both sectors, whereas because of more capex in the equipment rental, we can see slightly higher growth in that sector.
Okay, and on EBITDA side, we have achieved 58% EBITDA for equipment rental for this quarter. So is it sustainable going forward?
So the financial year EBITDA was 51%, and the quarterly EBITDA was about 58%. So I would say that anywhere between 50 to 55% is the sustainable range.
Okay, that will be all. Thank you.
Thank you.
Thank you. Next question is from the line of Surya Narayan, an individual investor. Please go ahead.
Yeah. Am I audible?
Yes, you are. Thank you. Please.
Yeah. Thank you, Himanshu ji, for giving me opportunity. Congratulations for